Hello and welcome back. Today we'll be diving into a crucial topic. We're going to discuss the HARCH model in detail. This is a key part of our ongoing series focused on volatility modeling. As is our usual practice, we'll be utilizing the resources available on the Finance Research Gate website. It's an excellent platform for our research. The HARCH model is quite a straightforward one, and its primary function is to effectively deal with the impact of past error shocks. It's absolutely essential that we don't lose sight of the fundamental purpose behind our financial return series modeling efforts. We're not directly modeling the variable itself, which is the actual return value, but instead our primary focus is on the volatility of the error term. For example, if we have the monthly stock return figures available, we are particularly interested in understanding and modeling the variability of the return movements, which arise from either errors or innovations. For instance, the specific return component is what we aim to analyze. We don't typically model the error because an error, by its very definition, is an unexpected component. Also, the mean error itself cannot be directly modeled because its expected value is, by definition, precisely zero. However, what we can effectively model and analyze are its dynamic characteristics, its movement, its fluctuation, its innovation, and its inherent volatility. This is something that can be effectively modeled. The GARCH model was indeed the very first one developed, and from that point we saw the emergence of many other related family members, including specific types like the eGARCH, the FIGARCH, and many others, etc. And the most recent addition to this entire group is the HARCH model. The specific variable h that we are considering here, just as a quick reminder, is actually representing the statistical variance of the error, which is the particular aspect we are trying to model. The magnitude of the statistical variance is subject to alteration, contingent upon two primary factors. First, a fixed parameter known as the baseline volatility, often denoted by omega, and second, the influence of the preceding error shock. So, the fundamental question we're asking is whether a previous period's error shock persists and influences the variability of the subsequent period. If these error shocks dissipate completely and instantly within the preceding period, then the corresponding coefficient in our model would naturally be zero. However, it is possible that we might observe some spillover effects where the impact of this error shock does not diminish or fade away right away. It may, for example, decay at a particular rate, which means that a prior error term will significantly impact this period's error or its variance. In our model, the expected sign for this specific parameter is determined to be positive. And if this sign is indeed positive, it strongly suggests a particular characteristic, that the residual error terms or the overall financial volatility tends to cluster, exhibiting periods of high and low activity over time. So this is essentially the basic structure or form of the ARCH model. The GARCH model, however, builds upon this foundation. It would be quite similar, but with a crucial addition. We incorporate the lagged variance, and that in essence defines what the GARCH model is. The HARCH framework, which we've just mentioned, is indeed quite closely connected to this particular concept. However, our intention is to thoroughly examine the various impacts of these shocks across a range of different time horizons. So, not only a 1-day lag, for example, we can have 5-day, 22-day lags, different horizons. For example, let's begin by considering this simple mean model. We'll assume that this particular expression represents the return equation, and its entire behavior is explained solely by its average value. So, the resulting difference, or the residual, So the difference between the return and the mean will give us the error term. The variance of the error term in our current model is specifically denoted as h. This implies that the occurrence and magnitude of an error shock are directly determined by this variance. Consequently, a higher value for this variance will inevitably result in a greater number of error shocks for that particular term. So Z in this context is what we refer to as the standardized random shocks. This is the well-known Z distribution, the famous distribution that is defined by having a mean of exactly 0 and a variance of precisely 1. A standardized random shock occurring within any given period will precisely determine the exact value of the error term for that specific time period, t. The variance in this context is simply the average volatility observed during that particular time period, t. So we are currently modeling the variance, or what's known as the h term, So the specific functional form for the HARCH model, as we've discussed, will take this particular structure. The variance in this context is essentially a mathematical function that depends on a constant value and also incorporates the baseline level of volatility, which we denote as omega, along with the crucial ARCH term itself, which, as you know, represents the squared error from the previous time period. And naturally, each error term must be squared, since our focus lies on understanding the volatility, or more precisely, the variance. And the variance itself is inherently a squared term variable. So this particular model we are discussing now is known as the HARCH. This represents a significant new concept we're introducing. Instead of solely relying on just the previous or lagged error term, we're now considering the average of the error term over a certain period of time. This allows us to use a different horizon when we're measuring the impact of the error shock. Instead of relying on just one single lagged error term, we now have the flexibility to consider multiple distinct horizons. For example, we might analyze a 5-day horizon to understand the impact of an error shock. Additionally, we can also incorporate a 22-day horizon into our analysis. That will reflect the monthly time horizon, for example, because we are taking the average of the error shock over the past 22 days, which is nearly the average number of trading days within a month.
Sorry, that would be, for example, a weekly planning horizon, perhaps.
So if we're looking at our daily observations, we can then identify various error shocks. Specifically, we'd have the lagged daily error shock, which is distinct from the weekly horizon error shock and also the monthly error shock. This approach allows us to analyze these errors across these distinct time horizons. Nicely, of course, it should be quite straightforward for us to fully comprehend the reason why we are taking this average, and that's simply because we are dealing with a different number of days in each instance.
So we absolutely cannot just add these values together directly, because that approach would simply create entirely different scales. So for instance, we're dealing with 5 days in this instance, but then we have a completely different scale of 22 days over here. That's why we must take the average.
So what's the main idea or the core concept behind all of this? The core idea is that different time horizons can actually have quite distinct and varied impacts. As an illustration, let's take the example of the weekly period. It could be that during the most recent week, the level of volatility has been quite abnormal, particularly when we compare it to the typical daily movements
Earlier in the month.
So in this particular instance, the alpha 5 coefficient, or perhaps this other coefficient, could potentially be much greater than the coefficient we're considering. It's also quite plausible that the lag term itself might be actively processing the absolute highest value that's available. So the idea here is that different horizons will have different impact on the volatility. So, in our current example, we're presenting 3 distinct scenarios. We have the initial 1-day shock, then we move to the 5-day block, and lastly, we consider the 22-day block. So in this specific analytical context, we are not merely assessing the immediate reaction, which is precisely captured and reflected by the ARCH component. We are also extending our scope to include a shorter-term horizon, for instance, a 5-day block, or even a significantly longer time frame, such as a 22-day block. There are various scenarios. For example, you might encounter 25, 27, 30, 35, and other similar values. There, for example, a HARCH model denoted as 1, 3 specifically include one ARCH term in its formulation. The number 3 in this particular notation indicates the order or the number of lags for that HARCH term. The HARCH term, as we discussed earlier, refers to the average shock experienced over a given period. For example, if we consider the number 3, that would then represent the average shock experience over the past 3 distinct periods. If the period is years, then this would represent the average shock experience over the last 3 years. If the period is defined as being on a monthly basis, then that would be the average of the 3 preceding months, and the same logic applies to weekly and daily periods, and so forth. So let's take a practical example by navigating to our website. From there, we'll select the time series data. We'll set the frequency to monthly. We should begin our date range from the year 2000 and then extend it all the way to 2024. Once that's done, we'll just click the apply button. Our objective is to calculate and establish a comprehensive market return. This software application is equipped with detailed firm-level data. Consequently, we will commence by employing the firm-specific variable, which is the monthly return figure. Then we proceed to aggregate these data across all the firms that are present in each given month, which ultimately allows us to create the overall market's monthly return. The specific method chosen for this aggregation process is the median. We could choose to use the mean, for instance, or perhaps the sum, or even the standard deviation. However, for our specific situation, the most effective metric to aggregate the data is the median. Medimean is our second best option, primarily because we're focused on assessing the average market return. While an average can be determined using either the mean or the median, we've chosen the median. This is because the median is considerably less affected by any extreme outliers in the data. At this point on this screen, should you decide to leave these input fields entirely blank, the system will, by its default configuration, automatically include every single firm. Then you would simply click the apply button to confirm. Specifically, our objective here is to determine the median monthly stock return considering all the firms included in this application, and we're doing this for each individual month. So ultimately, we're left with a single observation for each monthly return, covering the period from the year 2000 all the way up to 2024. These specific observations represent all the firms that are currently available within the application. So, for every single month, we carefully calculate the median value across all of these firms. Then we have the option to rename this particular variable, calling it market return. Then we click outside the box, give it some time to reflect the new name. And then, if you scroll down just a little bit further on the screen, you'll notice we have our very important time series variable, which, as you can see, is the market level variable itself. What we're presenting to you now is the monthly market return. It's quite evident that its fluctuation across time is clearly visible, which leads us to the conclusion that the overall volatility is quite significant. Now, the fundamental question we must address is whether we possess the capability to accurately model that inherent market volatility. If we can, then we would be able to quite readily predict and forecast the potential risk, or more specifically, the future volatility of the overall market return. Having a volatility present here doesn't necessarily mean that we can forecast it. Because even if you select a volatility model such as the GARCH or one of its family members, it may not be accurately capturing the volatility movements. So the volatility here, for example, appears to be quite small, pause. Here, it appears to be rather large, pause. So if the model can effectively capture the volatility movement over time, then we have successfully modeled the volatility of our variable. First, you'll want to scroll down to the very final section of the page. Then, you should carefully select the volatility section. After that, we need to identify our specific variable, which is the market return. Once that's done, we can then proceed to choose the HARCH model. So here we're looking at the ARCH lags. For now, let's just keep it at 1. You can leave that empty, or you can choose to retain a specific value. We will not be incorporating the GARCH model in this particular analysis. The reason for this is that our primary attention is directed solely towards the ARCH model and specifically examining the various ARCH horizon values which constitute the HARCH component. So, you can simply leave these specific input boxes exactly as they are currently configured. The system will not take into consideration the GARCH model at all, primarily due to the fact that the family of models which has been carefully selected is the HARCH. This box is specifically for the eGARCH model, which you would use if you want to accurately capture the asymmetric effect. The HARCH, however, is not concerned with the asymmetric effect. Instead, it focuses on how different horizon volatilities impact the overall volatility of the variable. Alright, so this particular section we're examining right now, this is the relevant box. Could you please explain what exactly these various horizons represent? To keep things consistent with what we've already discussed, we'll use the numbers 1, 5, and 22, just like in our earlier example. So, in this analysis, we're examining different time frames. We're looking at a single-day horizon, then a 5-day block horizon, and finally a 22-day block horizon. Now, it's important to note that since our primary variable here is defined on a monthly basis, these horizons must also be interpreted as monthly periods. So that would be 1 monthly period. We are considering the immediate horizon, then the substantial 5-month block that is recently concluded, and also the monthly horizon, specifically encompassing the preceding 22 days. The innovation distribution is specifically related to the Z value that we mentioned before. This particular one, and it generally tends to follow a normal distribution. So you have the option to select the standard Gaussian distribution. However, if you believe that the distribution of these error shocks actually exhibits a fat tail, then you are able to choose that. Similarly, if it possesses any degree of skewness, you can select that particular option and so forth. We'll select the normal one, then fit the volatility model. Alright, so let's take a closer look at the coefficients that we've calculated here. The omega parameter in this particular context serves as our fundamental baseline value, much like a constant term would in any standard equation. And then, alpha 1 is the specific coefficient that's directly attached to or associated with the influence of the 1-month error shock. Alpha 2 represents the specific coefficient that is associated with the error shocks observed over the preceding period of 5 months, and alpha 3, in a similar fashion, corresponds to the coefficient linked to the error shocks from the previous 22 months. Therefore, what we're doing now is providing a comprehensive summary of all these important findings. And this, in essence, represents the exact operational model that we have successfully implemented just recently. The first component we are examining is the lagged error shock which is precisely what we define as the ARCH normal term. The fifth variable in our analysis represents the average error shock calculated over the preceding 5 months. To derive this, we specifically gathered all the individual error shocks that occurred during the previous 5-month period. This means we had a total of 5 distinct observations to work with. From these 5 observations, we then proceeded to calculate their average value. Subsequently, this calculated average was incorporated and utilized as an independent X variable within our model. And for this particular case, in a similar manner, we measured the error shock from the previous month across the last 22 months. We then calculated the average, which we used as our X variable. First, the mean return is calculated as 0.007, and that's equivalent to 0.7%. It's 5%. This figure represents the average monthly return, the typical market's monthly return. From that average, we then estimated the potential error that we have carefully modeled here in our analysis. That is the baseline, so even if past error shocks have no discernible influence, even if the previous disturbances are entirely without consequence, still we observe volatility appearing. The past 1 month shows an impact of 0.27. Its impact, when considered against the average 5-month period, is 0.15, and the past average 22-month period has an impact of 0.11. So, the omega component, when analyzed independently, exhibits a significant impact on monthly volatility, specifically measuring 3.22. So, the standard deviation for the market's return, without taking into account the impact of previous error shocks, is found to be equivalent to 3.22%. This value represents the square root of this particular term. We need to calculate the square root in order to obtain the standard deviation. Looking at it on an annual basis, that's quite a significant figure, a full 11.2%, if you take into account the ARCH coefficients and their overall impact. Economically, they are sizable. Statistically, they are not significant. But it's certainly worth mentioning that alpha 1 is significantly greater than both alpha 5 and also alpha 22, which clearly indicates that a short-term impact is considerably larger than any longer-term impact, because in this particular situation we are considering 5 months prior to the current period. We are observing a period spanning 22 months. The coefficients assigned to these earlier months are notably lower than those for the most recent period, specifically from the short-term immediate past up to the current month. This structure implies a fundamental principle, that more up-to-date information is considered to hold significantly greater importance. However, as we have previously indicated, the statistical significance of these particular findings, when assessed by their corresponding p-values, is not considered to be statistically meaningful, since every single one of them falls above the 10% threshold. Therefore, volatility clustering is consistently observed at perhaps we should consider higher frequency data, such as daily or even intraday information. Monthly data, which we saw in the figure earlier, was present, but it wasn't particularly clear or easily visible. So the ARCH model, the HARCH version that we implemented, now effectively captures the idea of heterogeneous volatility. The reason for this is that our values are quite different. For the immediate, short, or near term, it appears that the present time frame exhibits a more pronounced influence on the fluctuation of the error term when we compare it to the preceding 5 months. And naturally, this effect is even more significant than what we observed over the last 22 months. So that concludes our time together for today. We truly appreciate you listening.